Hey everyone, welcome back to Corporate Decoder, the place where we decode the hidden stories within financial filings. And let me tell you, this latest one from Lumen Technologies Inc. and its subsidiary Level 3 parent LLC is quite the financial thriller. Their latest 8K report is full of some fascinating moves, especially when it comes to debt. Get ready, because we're diving deep into how these telecom giants are restructuring their finances, handling their mountain of debt, and what it all means for their future. Alright, so the big news here is that Level 3 financing, a key part of Lumen, has just completed a massive upsized offering of $1.25 billion in what they call 8.500% senior notes due 2036. Think of these as ISs that they're selling to investors, promising to pay them back with interest over the next 12 years. This is a huge pile of money, and they're using it to do some serious financial surgery. To make this official, they've signed an indenture with a trustee, which is basically a very detailed contract outlining all the terms and conditions for these new notes. This document is super important because it lays out exactly how much interest is being paid when it is due, and frankly, what happens if things go south. Now, why all this new debt? They're using the money, along with some cash they already had, to buy back some older debt. Specifically, they're purchasing existing second lien notes through something called tender offers. This is a strategic move. They're essentially refinancing their debt, swapping out older, potentially more expensive or restrictive debt for this new, larger issuance. So the clock started ticking on the 23rd of December 2025 for interest. It is going to be paid out twice a year on the 15th of January and the 15th of July, with the first payment coming up on the 15th of July 2026. The effective interest rate is 8.5%, which is a pretty significant cost of borrowing. Here is where it gets a bit technical but crucial. These new notes are called senior unsecured obligations. That means if Level 3 financing ever ran into serious trouble and couldn't pay its bills, the holders of these notes would be among the first in line to get their money back, but only after those with secured debt, meaning debt backed by specific assets, get paid. They are also effectively subordinated to any debt held by Level 3 financing subsidiaries, unless those subsidiaries also guarantee the new notes. And speaking of guarantees, this is a big deal for investors. Level 3 parent, the parent company, along with certain of its material domestic subsidiaries, are fully guaranteeing these new notes. This means if Level 3 financing can't pay, these other entities are on the hook. This provides an extra layer of security for the investors, making these notes more appealing. Now let's talk about when the company might want to get rid of these notes early. Before the 15th of January 2031, they can choose to redeem some or all of them. However, it is not as simple as just paying back the principal. They have to pay the principal amount plus a make-whole premium. This premium is essentially compensation to the bondholders for the lost future interest payments. It is designed to make it financially painful for the company to refinance at a lower rate too early. After the 15th of January 2031, they can redeem them at set prices outlined in the indenture, which are likely closer to par value. There is also a change of control clause. If something significant happens that changes who controls Lumen Technologies, Level 3 financing might have to offer to buy back all these new notes at a premium. Specifically 101% of their principal amount. This protects bondholders from being stuck with debt from a company they didn't originally invest in. Like any major debt agreement, this indenture has events of default. These are trigger points. They include failure to pay principal or interest, breaking certain promises or covenants that last for 90 days after notice, or if the parent company or key subsidiaries face severe financial distress or bankruptcy. If these events happen, the trustee or a large group of note holders can demand immediate repayment of the full principal amount. And these covenants are important. They limit the company's ability to take on more debt, grant new liens, which are claims on assets as security for debt, or engage in certain business activities without getting approval or meeting specific conditions. These are the guardrails that financiers put in place to protect their investment. A key detail here is that these notes and their guarantees are not registered with the Securities and Exchange Commission under the Securities Act. This means they weren't offered to the general public. Instead, they were sold to qualified institutional buyers and non-us persons under specific exemptions. This is typical for large debt offerings as it streamlines the process. Now, shifting gears slightly, this report also details changes to their older debt. In connection with those tender offers we mentioned, Level 3 financing has also entered into supplemental indentures for their 4.000% second lien notes due 2031, 3.875% second lien notes due 2030, and 4.500% second lien notes due 2030. These are the amended second lien notes. The big move here is that they're eliminating substantially all of the restrictive covenants and certain events of default. On these older notes, they're also releasing the collateral that was securing these notes. This is a pretty significant shift. By removing covenants and collateral, They are making these older notes more akin to unsecured debt and removing many of the protections that investors originally had. These changes to the second lien notes don't happen overnight. They only become effective once the final settlement date for those specific notes occurs. This means it is a phased approach, likely tied to the success of their tender offers. This section essentially just points back to the information we've already discussed regarding the new debt issuance. It confirms that these new notes are a direct financial obligation for the company. The company also put out a press release on the 22nd of December, announcing the early results of these tender offers and consent solicitations. This is where they're getting feedback from investors on whether they're willing to sell back their old debt. The goal of these tender offers and consent solicitations, as mentioned, is to get investors to agree to these amendments, effectively taking away covenants and collateral from the older debt. As expected in any filing like this, there is a section on forward-looking statements. This is the company's way of saying, hey, we're talking about the future here and things might change. They use words like will, should, and expects to talk about future plans. But they're also warning investors that actual results could be very different due to various uncertainties. It is standard legal practice, but always good to remember that the future is never set in stone. And finally, the filing lists out all the exhibits. The most important ones here are the indenture we talked about for the new notes, and the supplemental indentures for the older notes. These documents are the nitty-gritty details that lawyers and finance pros pore over. So, what does all this mean for Lumen Technologies, Inc.? And its subsidiaries? On the one hand, issuing $1.25 billion in new debt to refinance older debt can be a smart move. It allows them to potentially lower their overall interest costs, extend their debt maturities, and gain more financial flexibility by shedding restrictive covenants and collateral on some of their existing debt. This can be crucial for a company in the competitive telecom space, which often requires heavy investment in infrastructure. However, taking on so much new debt also significantly increases their overall leverage. Their debt-to-equity ratio will likely climb, and with it, the financial risk. The 8.5% interest rate on the new notes is not insignificant, and they'll have to generate consistent cash flow to service this debt for years to come. The elimination of covenants and collateral on the second lien notes is particularly interesting. While it gives level 3 financing more freedom, it weakens the position of the holders of those older notes. If the company's performance falters, these holders will have fewer protections compared to what they initially signed up for. It's a clear signal that Lumen is prioritizing flexibility for the parent company and its future operations over the traditional protections afforded to certain classes of debt holders. The company's direction seems to be one of aggressive financial management, aiming to simplify its debt structure and potentially reduce its cost of capital. The strength lies in their ability to access such large amounts of funding, indicating that investors still have a degree of confidence in their long-term prospects. The weakness, however, is the sheer volume of debt and the associated interest burden, which can be a drag on profitability and limit future investment or strategic options, especially during economic downturns. A notable risk is the sustained competitive pressure in the telecommunications industry. Companies like Lumen are constantly battling for market share, and technological advancements can render existing infrastructure obsolete, requiring continuous and costly upgrades. This new debt load could make it harder to fund those necessary innovations if cash flow tightens. Lumen and Level 3 financing are making bold moves to reshape their financial landscape. They're essentially betting that they can manage this increased debt load, and that the flexibility gained will outweigh the risks. It's a calculated gamble. What is your take on these debt maneuvers? Do you think Lumen is making a smart play, or is this a risky path? Let me know your thoughts in the comments below. If you found this deep dive helpful, please hit that like button and don't forget to subscribe for more corporate decoding. Also, check out our Discord community linked in the description for more discussions and insights. Thanks for watching, and we'll see you in the next one.